Okay. So the same process that we followed for the first quiz, we'll follow for this as well. So as soon as it's done, I'll let you know. I'll send you the solution. I tried to set up the quiz. So the first two questions I thought were gimme questions. There were 2 points apiece. Though some of you, as I saw you work through them, made them less than gimme questions. There was involved calculations that I did not understand why you needed them to get where you needed to go. But you'll find out when you get the quiz back. Okay? Second, and I hate to pile on, if you're going to turn in your DCF for feedback, try to get it in by Friday. It's not a hard deadline. So if you finish on Saturday morning and you send it, I'm not going to say it's too late. I will try to get to it. The only problem is if it spills over into next week, I'll have trouble because I have quizzes to grade on Monday that I'm going to be giving in my other classes. So I'd like to get it done by this weekend. So try to get it in as soon as you can. You don't have to wait till Friday at 5 o'clock either. If you're done already, and many of you have already sent it in, I'll send it back to you. It's not, don't expect some deep question, like assessment, like you got the revenue growth of 28, it's 31.3%. I'm not going to give you that kind of feedback. I'm incapable of doing that. It's mostly going to be about your story, your numbers, and how they play out. And if there's something that sticks out to me and I say, look, that number doesn't make sense, I'll let you know. So if you remember the last session, we were talking about Amazon. We valued Amazon, and I showed you my valuation, value of $35, stock price of 84, and I told you why I would not sell short. Nick, why would I not sell short? What was the reason? Yep. The quiz kind of killed your brain cells, huh? Daisy, what about you? Why wouldn't I sell short? What was it that stopped me from selling short? Do you remember? No? Go ahead. Time is not my ally, and I need time to be my ally for the correction to happen. So what I'd like to do is take that Amazon valuation and talk a little bit about some of the things in that valuation that some of you are going to run into if you're valuing young growth companies. So if you're valuing young growth companies, the next phase is going to be, hey, these are the things I learned from Amazon. Hopefully they'll help you when you value your company. The first is, remember what you said about regression betas? Warang, what did we say about regression betas? Don't trust them. You know, she actually told me that. I just said it louder. Don't trust them. Why? They're backward looking, they're noisy. What I said about regression betas for all companies applies in spades when you're talking about a young company. And here's why. This is Amazon's regression beta in January 2000. The raw beta is 2.23. You're saying, that's great, I have a raw beta. But before you use it, take a look at the standard error on that beta, 0.50. If my regression beta is 2.2 and my standard error is 0.50, can anybody give me the range on my beta? I mean, even if I trust this regression, what's the rule with standard errors to get the range? Plus or minus 2 standard errors. The true beta for Amazon can be somewhere from 1.2 to 3.2. Sachi's valuing Duolingo. Do you have a regression beta for Duolingo? You could probably pull it up, right? Because it's going to be incredibly noisy. The company is changing. You can already see statistically, business-wise, it doesn't make any sense. So you're saying, how do you get a beta for Amazon? I used 2 different peer groups. For the first 5 years, I used just online retailers. Remember, in 2000, online retailers were all young, they were all evolving, different fixed cost structure, and there were enough of them out there that I could focus on just that to get my beta. But by the time I get to year 5 in my forecast, if you remember, my revenues for Amazon are $19 billion. It's no longer a small company, it's a big company making money. So I'm going to make the argument that once they get there, when I think about Amazon, I'm going to think about retail first. Oh, by the way, they happen to be online. This happens in every new phase, right? Initially, you say it's a social media company. But as the business evolves, eventually it's an advertising company that happens to be on social media. If you remember, I gave you my averages by sector that I report on my website. This year, there was one grouping that I had to remove because I could no longer find companies in that grouping. It was online retail. Until last year, I had a separate grouping for online retail. This year, I could not. Because S&P Capital IQ, rightly, I think, has decided that we've gotten to a stage in retail where every company at some point in time is at least, I mean, you take Target. Target gets about 25% of its revenues from online retail. Every company is partly online retail. So that grouping has now disappeared. Retail is now the space. So for the first 5 years, I used the betas for online retailers. But as I go past year 5, I move towards a beta for all retailers. That's a 1.60 to 1. Now let's talk about the big two numbers. The big two numbers in my valuation, I'll accept up front, are my revenue growth number and my operating margin number. I used a revenue growth rate, a compounded annual growth rate of 42% a year. And your reaction was, you made that up. And I did make it up, but I did make it up on something that I thought had a basis. Again, I'll take you back to when I valued Amazon in late 99, which is when I did this valuation. And I'll take you through the process I initially followed and why I gave up on it. The way I was taught to do valuation, and everybody was taught to do valuation, and there's still in many valuation classes, this is the way it's taught, is to do things sequentially. You know what I mean by that? You do year 1, then you do year 2, then you do year 3. It makes sense, right? And I discovered that by the time I got to year 3 with Amazon, I was pulling my hair out and I was driving myself crazy because year 1 was already tough. Year 2 was even tougher. Year 3, I have no idea what's going on. So I decided to do something differently, which I still follow when I value young companies. Next few words I'm going to say are going to sound Deepak Chopra-like, and I hate that guy, but I'm going to say them anyway. But to value Amazon, I had to visualize what success would look like at Amazon. What will this company look like 10 years out, given what I know about the company, the business, its management? See, that's very subjective. Guilty as charged, of course it's subjective. So in 2000, I wanted to get a sense of, and in early 2000, I'll be quite honest, I treated Amazon as a retail company. That's what it did. I didn't think it was going to get out of that space. So I wanted to see what success would look like. So I had to figure out what does a successful retail company have as revenues? So where do you think I went to get a sense of that? I went to look at I listed out the top 20 retailers in the world. Walmart was on top at that time with 200 billion in revenues in 2000. And then you had, the Gap and the J. Crew at 18, 19 billion, around the 17th, 18th, 19th rank. Here's the question I'd ask myself: where on this list would I see Amazon 10 years from now if it goes in the path? I said, will it get as big as Walmart? My answer is probably not. It's not that kind of business model. It's not a discount retailer that sells stuff at a tiny margin. Will it be like the Gap? I thought it would be bigger. Gap is just apparel. This is going to be more than apparel. I went back and forth, and eventually I put them between the 5th and the 6th largest retailer in the world. And guess what their revenues were? About $40 billion. So I know where I am. I know where I'd like to be. So all I have to do is come up with growth rates that get me from where I am today to where I'd like to be, right? So how do you come up with these growth rates? And I just made them up. You didn't mishear me. I just made them up. And if you made a big deal about any of those numbers, I'll give them to you. So you made a big deal about year 1. I think it's going to be 163.35%. You can have that. You want year 2, take that too. You give me the starting and the ending points in this valuation. I control the valuation. With young companies, it's the end game that drives your value. Not the near game, not the middle game, but where you think that. So if you came to me and had a different vision of what Amazon would look like as a successful company. So in your story, you say, I think Amazon can be as big as Walmart. That would give you a very different value. So that's how I got the revenue growth rate, is by working backwards. Now you can see why this will be easier in some businesses than others. With Amazon, the business was already formed. It was a retail business. The fact that you're online doesn't change the overall business. With Uber, it was messier because I thought it was the car service business, but as it entered the business, it was making the business bigger. But some of you are working in spaces where you don't even know what that end business is going to look like. There is no measure of successful. There, your challenge is far greater. But you have to visualize what success will look like in this company. Let's move to the margins. I'm right now at minus 36.71% margin. Let's start with the easy question. If I expect that to stay minus 36.71% every year for the next 10 years, what value am I going to get for Amazon? It's going to go bankrupt, right? I chose a target margin of 10%. If you remember, that's a 75th percentile of retail companies. I'm telling a story of not only a bigger retail company, but one that's going to be successful. I need to get from minus 36.7 to plus 10%. And I'll tell you what I don't want to do. I don't want to be sitting there estimating margins in year one, margins in year two, margins, because again, I have no idea. So I gave my spreadsheet an algorithm and asked it to fill in. Because my initial spreadsheet, I had the starting number, the ending number, blanks for my margin. That's not going to work. It says fill in the numbers. And it magically did with my algorithm to guide it. So I'd like you to figure out what algorithm you think I used to get from mine. It looks awfully precise, right? It looks like I have a crystal ball, minus 13.35%, minus 1.68%. Where do you think how do you think I'm coming up with those intermediate numbers? Or what is the algorithm that you think I gave the spreadsheet? Yes. Oh, okay, so let's say, where are we now? Minus 36.7. Where do I want to be? Plus 10. What's the distance between the 2 points? 46.7. I took half the distance. Now I'm at minus 13.35. Where do I want to be? 10. I took half the distance. You're saying, why half? Why not? When I build spreadsheets, here's the way I think about it, right? I am telling a story about Amazon. My story, I'm moving pretty quickly towards my target margin. It's my story for pathway to profitability. It's kind of a smooth, but let's say you like the rest of my story, but you disagree with that part of the story. You say, look, I don't think the pathway to profitability is going to be as easy as you think it is. You know, all you have to do, take the half and make it a quarter. If you make it a quarter, guess what happens? It's the same starting and the ending point, but I lose more money for a longer period. If you're more optimistic, you say make it 1, in which case you get to plus 10% next year. That's an incredibly upbeat story. When I try to value companies, I want to create mechanisms where if you disagree with me, it's easy for you to adjust for it. That's my pathway to profitability. As my margins go from negative to positive, my losses become profits. It's almost magical on a spreadsheet seeing this happen. And then I have to compute after-tax operating income. In the first 3 years, my EBIT and my first 2 years, my EBIT and my after-tax EBIT are identical because I'm losing money. In year 3, I start to make money, but I have no taxes. Why? Because I'm keeping track of not just the NOLs I came in with, but the losses I made in years 1 and 2. This builds the NOLs into your taxes and into your cash flows, rather than keep it separately, as some investment bankers and appraisers do. And at the end, try to bring it in. It's all in there. So as I eventually run out of the NOLs, I cut to my tax rate. That's why if you're a money losing company, I said, enter a 0 tax rate from now. Tell me what your marginal tax rate is, and I'll get there for you. Because if you try to override it, strange things will start to happen in your valuation. Just leave it as is. So effectively, I'm moving you over time towards your marginal tax rate. Small company becomes big company, money losing, money making, tax, non-tax paying, tax paying. I've got my after-tax operating income. Now, as I do all of this, I have this 10-year horizon. A few of you have already pushed back and said, oh, my company is going to grow longer than 10 years. Why did you? First, if you really want to make your time horizon longer than 10 years in the spreadsheet, it's doable. It's a spreadsheet. There isn't a single, I've never ever written a macro. I say this proudly. My spreadsheets are very, very simplistic spreadsheets. So if you want to extend it out to 20, be my guest. But I'm going to stop at 10 years and I'll give you my rationale why. This is actually perhaps the most depressing study I've ever seen if you're a growth investor. It's a study that looked at IPOs and looked at the revenue growth of companies that go public relative to revenue growth for the sector that they belong in. So I'll start with the good news. The year that they go public, so that's year one, their revenue growth is 15% higher than the sector. You're saying, there, that's why I bought this company, high growth. 2 years after, that difference is 7%. 3 years after, it's 3%. By the time you get to year 5, you can't tell the difference between this high growth company that went public and the rest of it. Growth in the real world fades really quickly. The median growth period for a growth company in the US in the last century has been 3 to 5 years. Why is that? Why is it so difficult to maintain high growth? What are the forces that work against you? Yes. One is scaling, right? There's a scaling effect, it gets more difficult. So that's always going to be the case. It applies to everybody. Second is when you grow fast, people notice you, right? In a good way. But when people notice you in a good way, they start to say, why can't I do what that person does? When startup founders talk to me, sometimes they call and say, can you give me some advice? They expect me to ask questions. So what are you going to do if things don't work out? And the question I always ask them is, what do you plan to do if things work out much better than expected? See, that's a good thing, right? My revenues grow 300% over the next, it is good. It's a good thing, but people will notice. When they notice, they're going to come after you. And many of these people have much deeper pockets than you do. That's why if you watch, if you watch VCs questioning founders, one of the questions they often ask, what are your barriers to entry? What keeps you, ahead of the game? So when I use 10 years, I'm already at the 90th percentile of growth periods for growth companies. Are there companies that have grown for longer than 10 years? Absolutely. But the fact that we can name them tells us that they're the exception rather than the rule. So when you value growth companies, 10 years might seem pessimistic. It's too short, but in the larger scheme of things, you're at the 90th percentile. This is a pretty successful growth company. Lesson 4, that lesson we talked about in the context of growth with any company. For a company to grow, it has to reinvest. You can't forget that lesson when you're looking at young companies. The only difference is you connect the reinvestment to your sales rather than your income because there's no income to begin with. This was the part of my Amazon valuation where I got stuck the longest in trying to come up with that reinvestment. And ultimately, I concocted, invented, whatever you want to call the sales to cap ratio as my connecting device. So what I do is take the change in revenues, use the sales to capital ratio. That gives me my reinvestment teacher. Now, we don't usually think about reinvestment in this way, but reinvestment that goes into free cash for the firm is actually a delta in your invested capital. In some of the quizzes, you probably notice that when you reinvest, your invested capital grows. So I actually kept track of my invested capital based on my reinvestment. You're saying, why? I estimated after-tax operating income on the previous page, right? I've estimated invested capital in this page. What if I bring the two together? What's after-tax operating income divided by invested capital? That's return on capital. The last column, I have my imputed return on capital. I don't actually use it, but it actually comes out of my valuation. You're saying, why bother? In the case of Amazon, that number works out to be 20.39% in year 10 based on my revenue growth, my margins, and my sales to capital ratio. And I was okay with it. Remember, this was 2000. The T-bond rate was 6.5%. Retail companies collectively made 18 to 19% returns on capital. So I can live with 20.39%. But what if this number had been 200.39%? What's my spreadsheet yelling out to me? You're not reinvesting enough. And if I'm listening, what should I do to fix it? I should go and lower the sales to capital ratio and reinvest more. Use the feedback loop. And this is actually the last row in the valuation worksheet. I actually computed your imputed return on capital. I don't draw your attention to it, But if you take a look at it, you'll see what kind of company you're building with your reinvestment and your margin and your growth assumptions. If this had been 2.39% in year 10, I have a different problem. I'm reinvesting too much. Some of you have, have turned in valuations where your value for equity is close to zero. These because you're reinvesting so much over the next 10 years, you're killing your company. There's nothing left there. So take a look at that imputed return capital because it's going to give you some sense to do. Last session, we talked about dilution. In the case of Amazon, there are two places where there's going to be dilution. One is they have negative free cash flows for the next 6 years, which they're going to cover with new equity issues. That's going to cause dilution. What's the other thing that's going to cause dilution? There are options, right? That huge option component. And it seems like I've ignored both because when I came up with the value of equity, I divided by the actual number of shares outstanding today. But in a sense, I've already considered both aspects. Those negative cash flows in future years have reduced my value of equities. If you remember, I got a $15.2 billion discounted cash flow value for the equity. That would have been 20 billion if I hadn't had those negative cash flows for the next 6 years. I've in effect reduced my equity value by about 25%. That already captures the dilution effect of future share issuances. What about options? I actually valued the options as options and subtracted them from the value of the equity. Yes. Why are they issuing the equity? Where is it going to go? Just go into cash balance and just, in a sense, that's almost a neutral effect, right? No, but that has to be any reinvestment. I mean, we're working in circles, right? When you estimate free cash flow, embedded in there is a reinvestment. So you either put that number in the reinvestment and show it as a negative cash flow, but you can't have a positive free cash flow to the firm where you built in a reinvestment, raise equity on top of that, and not tell me where it's going. Right? So that's why if you have any valuation in equity, the only time equity issuances make sense from a valuation perspective is they're going to cover reinvestment. If you're just raising money to put into cash balance, it's a neutral effect. It'll have no effect on your value per share. That's why we ignore them. Right? Now, there is a chance that Amazon failed. One thing that I ignored in early 2000 when I did my Amazon valuation is when I did my first 6 years of negative cash flows, I assumed that they would be able to raise the capital and keep going. Why? Because in January 2000, the world thought that .com companies were going to conquer the world, and I was caught up in the mood of the moment. But the truth is, my $35 value probably should have been lower because there was a chance, even in January 2000, that Amazon would not make it. Now, to make real how much failure there is in businesses, this graph kind of brings it home. It's actually from a data set maintained by the Bureau of Labor Statistics. Don't ask me why they maintain this data set, but they actually track new startups around the country, and they track how many of them make it through year 1, year 2, year 3. So let's take as an example, natural resource, and they break it down by sector. Natural resource companies, for every 100 companies started, 82 make it through year 1. And by the time you get to year 10, whatever year that is, year 7, only about 35 are left. In the first 7 years of natural resource companies, 65 drop off. So it shows you how much failure risk there is in businesses, but it also shows you that the biggest failure risk is in the first few years of the business. Infant mortality for businesses. So when you're valuing a young company in year 1, there's a much higher failure risk than when you value a young company in year 3. If you're valuing a young company when it's going public, it's already been around 6, 7, 8 years. Your failure risk is not going to be 80, 85, or 90% because it's made it through the most painful part of the process. In fact, I have an update from 2019. If you go to my website, I have the 2023 update. If you're interested, you can go to the Bureau of Labor Statistics. It's public information, and download this table, and it gets updated every year. It's an interesting table because they track, I think, up to 15 years, how many companies make it through in each sector. Any questions? Yes. Not that much. In fact, the failure risk is going to become higher simply because the technology has made things even more volatile than they used to be. Companies fail more frequently. So the technology sector in particular, you see a big increase in failure risk. Yeah. So I finished this valuation. I come up with $35 per share. I say, I'm not selling short. I'm getting ready to hang up and finish my call when I get a very plaintive question from somebody who probably owns Amazon stock at that point in time. And she asks, is it possible that Amazon is worth $84 per share? What's the answer to that question? Yeah, of course. Possible is such a weak word. In fact, to get to 84, if you think in pure mechanics, what do I have to do? Have higher revenue growth or higher margins, right? In fact, those are the two key drivers. So here's what I did. I took my revenue growth. Remember, I had a 42% compounded average, and I tried growth rates as high as 60%. Remember, at a 60% compounded revenue growth, Amazon becomes a $150 billion revenue company. So it's exponential. The effect gets greater and greater. And I tried margins ranging from 6 to 14%. You're saying, what's those yellow shaded areas? Those are the numbers that exceed the $84 per share. In other words, I'm trying to figure out the break-even point. What has to be true for your value to be greater than 84? Well, you got to grow like Walmart and have margins like Ann Taylor. And if you're okay with that, by all, it's a different way of framing whether to invest. There's a book called Expectations Investing, written by Mike Mabusson, one of my favorite people in finance. And that entire book, instead of valuing companies and coming up with a DCF value, you frame the question of what has to be true for NVIDIA to be worth $900. So essentially, it's a break-even table. How much revenues would I need? And it actually is an interesting way of saying, do I feel comfortable buying this company requiring $1 trillion in revenues and a 45% margin just to break even? So as you're doing all of this, what's the question you keep asking yourself? Am I wrong? I'll save you the trouble. You're going to be wrong. You know what percent of the time? 100% of the time. And why are you going to be wrong? Because you're not God. You're trying to forecast the future. There are things that will happen that are out of your hands. You're saying, then why bother? You know how many people refuse to do intrinsic valuation because they can be wrong? It's absurd. Because you don't have to be right to make money. You just have to be less wrong than everybody else, right? It brings down your anxiety levels. Am I right? Am I right? No, you're wrong. You just have to be less wrong. So you get an input. Don't beat yourself. How do I know that's right? It's wrong. That takes your anxiety out. But hopefully it's a little less wrong because you did some background research on the business, on the market. And that's all you can do is value companies given what you know today with the information you have, with the tools you have today. So that was my Amazon valuation in January 2000, massively overvalued. And I did the song and dance of how I couldn't sell short because at the time was not my ally, and I got away with it. A year later, I get a call from the CFA again saying, can you come back and give another talk on valuing .com companies? Saying, we did the one last year. Why would you need? Because in that intervening year, what had happened? The .com boom had bust. The economy had gone into recession and the world had shifted. So I revalued Amazon and my value went from $35 to about $20 per share. I think that is terrible. Your value changed that much. Let's think of all the things that changed. First, I brought failure risk into my value because by 2021, it was quite clear, or 2001, it was very, very clear that you could fail as a .com company. Second, this outlook for online retailing being this inexorable, win that at the end they were going to make, that seemed a little more difficult to justify. So my value went down because I got more pessimistic about the company, the market, and overriding all of that is the economy. So I finished this valuation. There were people who had been in the previous year's session. And they said, aren't you uncomfortable that your value changed so much? And I said, after a year like last year, I'd be uncomfortable if my value didn't change this much. And if you think I'm being, I'm being volatile, changing my value from 35 to 20, how would you describe the market? Because the market went from $84 down to $11 per share. And I was trapped. You know why I was trapped? The previous year when they asked me whether I would sell short, I said, no, you can't do it. Time is not my ally. Now I have no excuses, right? So are you buying? And I said, yes. And I could have been lying. They would never have known. In those days, you couldn't get into other people's brokerage accounts. But I did buy Amazon for the first time in 2001. In the 23 years since, I bought Amazon 5 times. I've sold Amazon 4 times. which kind of tells you where I am with Amazon right now. But the point I'm trying to make is never say never in investing. I hear people say, I will never buy NVIDIA. You might not buy NVIDIA at $900, but you should definitely buy it at $200. Companies can go from being overvalued to undervalued to overvalued. And even the most successful, I took the Fangam stocks or the Mag 7 stocks. Over the last 20 years, NVIDIA has been undervalued at least 3 times. I got it on one of those 3 times, been undervalued at least 3 times. So when you value a company and you find it overvalued, you probably say, that was a waste of time, not much I can do. But remember, that value can be revisited, the price will change, and things can shift over time. In fact, that 2001 valuation that I bought Amazon, I revalued in 2002. You're saying, why are you bothering? Because once I buy something, I have no choice but to revalue. Do you see why? Because if you buy something when it's undervalued, you can't just buy and forget. Because if you stay true to your philosophy, I buy things that are undervalued, when should you sell? When they get overvalued. The only way to find out is to keep you're saying, this is a pain in the neck. Buy an index fund then. You know, if you truly want to do value investing, it is a pain in the neck. It requires, and if you don't enjoy the process, why are you torturing yourself by doing this? Now, since I've been valuing Amazon so many times and for so many years, this is something I try not to do because it's often very depressing to see how wrong you can be. I got in 2014, I decided to look back at my 2000 valuation and compare it to what the actual numbers at Amazon were. So let's start with revenues. I had projected revenues of 40 billion in 10 years, and I kept the growth rate going. My revenue should have been 51.5 billion. Their revenues are actually 85.2 billion. Let me pause right there. What is Amazon showing me? That my revenue story is too small, that they were much. So that's a good side of what Amazon showed me. Let's take a look at margins. My target was that they would get to 10% margins in year 10. Well, they got up as high as 4.61%, and then they seemed to have some reversal and they kept going down towards 0. Clearly, Amazon is doing something that my original story did not encapsulate. So what do you think Amazon? Now, in fact, they were moving towards becoming a more mature retail company. And then it's almost in 2010 or 2011, it's almost like they decide to reinvent themselves and go back to being a young company. But that's still retail, right? Yeah. They started, basically they started going into other businesses, right? The point about increasing prices and the margins, that was going through the entire lifetime, but they were still moving in the right direction. Yeah. In fact, they became, we tell a story about a company. My story for Amazon, I remember the year that it changed. In 2012, I took a look at Amazon and said, this is no longer a retail company. It's a disruption machine. You know, the way I described it is Amazon is not in the retail, but it's basically going to be in any business that it views as being a soft business. So it's a soft business, a big business, inefficiently run. It became a disruption machine. And to me, it's made Amazon the most difficult company to value in the world. Do you see why? What's the total addressable market for a company that can be in every business? Who the heck knows? In fact, this was the valuation I did of Amazon. I think about 2016, 17, some there. And I valued as a disruption machine, huge potential revenues. In fact, my projected revenues was 626 billion at that time. They're actually pretty close to that now. And they moved in, and they're in multiple. I remember in 2016, I was valuing Amazon, and somebody asked me, when I was showing them the 2000 valuation, and they asked me, why didn't you build a cloud business into your 2000 valuation? Hindsight is 2020, right? I mean, all you can do is value companies based on what you know today and what you see today, and things will change in good ways or bad ways. It isn't always good news like it was for Amazon. So that's the Amazon valuation. Let's move to the second phase of the life. Usually, yeah, go ahead. Now, my story for Apple for the last 15 years is the greatest cash machine, a slow moving, a slow growth, cash machine. Will that throw, I think it's going to cause some costs. I think eventually the antitrust thing is not going to go very far, but I do think it's going to make the near term. So to me, that kind of throws a friction into the story, but fundamentally that Apple services business they built is a threat from the antitrust, because that's where the antitrust is going after. You know how Apple makes money on every app that lists on their ecosystem, right? They collect a piece. That's why Netflix is not available on the Apple apps. You have to go to Netflix and download it directly. So that's what the antitrust is going, is breaking up that business where you have to go through the Apple store to be able to sell an Apple product or software. I think a lot of the gaming companies have had trouble with that as well, because Apple then collects a piece of that. So that could put the services business, which has been the one growth business, potentially at risk. But let's face it, what is Apple? It's a smartphone company, right? That's the reality. I realize that as somebody who owns a MacBook Pro, that I'm fifth or sixth on the list of their priorities. Okay? So that's something to factor in when you look at Apple. Is each of these companies as a different threat? None of them is a high growth company anymore. But they don't have to be. When you have 300, 400, 500 billion in revenues, 8% growth is still a substantial jump in revenues. Let's talk about mature companies. Mature companies should be the easiest to value, right? They've been around a long time. They're set in their habits. They do the same thing. Let me ask you a question. Do many of you do the same thing every day? Do you go to the same coffee shop and buy the same? We all fall into patterns, right? Are some of those patterns unhealthy? You should probably stop going to that ice cream place on whatever it is that charge you dilution. Is that what it is? Because you've been going there every evening, or that cookie place that's open all night. You might have fallen into. Let's face it, you can do the same thing, but some of those things might not be good. With mature companies, that can become an issue. You've been doing the same thing, but it's no longer working, but you keep doing it. So when you value mature companies, on every question, you can have two potential answers. One is you can come up with an answer based on what you're doing right now, and then you can come up with a different answer if somebody else ran the company today. So what are your existing cash flows? You can tell me what they are with the existing policies you have and what they would be. I mean, take Disney, right? Let's say you had Nelson Peltz in one room and Bob Iger in the other room. With each of the questions, are you going to get different answers? Yes, because each has a different vision of the company. You see, what do I do then? Do two valuations, a Bob Iger valuation and a Nelson Peltz valuation with different policies built in. You as an investor still have to make a judgment on those. So I'm going to use a company to kind of illustrate this called Hormel Foods. You guys familiar with Hormel Foods? Anybody know what its most famous product is? Perhaps the most disgusting thing I've ever seen sold as a food item. It's called Spam. What is Spam? It's this meat-like substance. That's the only way I can describe it. That comes in a can that can outlast a nuclear war. I mean, you can actually eat it 200 years from now. How the heck you make something that looks like meat that you can eat? I don't know. I don't want to know. But Hormel Foods is a very long-standing family, food processing company. And like many other food processing companies in the US, they used to be family-owned by the Hormel family. Then it became family-controlled, and now the family is gone. They have a foundation that owns 23% of the shares, but it's run by managers. But they're set in their ways. So my first valuation is of Hormel as is. Very conservative management on two dimensions. They think the world ends on the borders of the US. They have very little global plans. So they reinvest very little and grow at a low rate. And the second is they don't like debt. They don't like to borrow money. Their debt ratio is about 10%. That affects their cost of capital. So they don't reinvest very much. They have a low growth rate and they don't use debt. But they're set in their ways. That's what they do. I did a second valuation where I assumed that somebody else would run the company and go crazy and give them 50% growth rate. They're not a tech company or an AI company. I assumed that they would reinvest a little bit more at a lower return on capital. So accepting low, still higher than the cost of capital, so higher growth rate, and that they would use a little more debt in their capital structure. No leverage buyouts, 20% debt, 80% equity. So slightly higher growth, lower cost of capital. I came up with a value of $38 with that and $32 with the status quo. I have two values for the company, right? Let me put you in the middle. You're an investor. The stock is trading at 33. You're saying, should I buy the stock? What's that going to depend on? Which scenario you think will play out, right? Which is really at the heart of corporate governance. This is what we mean when we talk about corporate governance. So I tried to assess the likelihood of change. So what are some of the things you'd look at to assess the likelihood of change? Good. So you're going to look at the shareholding pattern, right? I'll tell you, the biggest single shareholder is the Hormel Foundation. If they come on your side, change will come, right? So I took a look at the Hormel Foundation to see who ran the foundation. And my stomach dropped. My hopes dropped almost immediately because the head of the Hormel Foundation was also the CEO of Hormel. Kind of creates a friction here because you're not going to ask for your own firing because that makes no sense. So I attach a very low probability to change. I thought about putting 0, but Hershey's used to be structured the same way, but they finally changed. So next class, when we start, we're going to talk about how do we come up with that debt ratio to use that you can move to if you have a very conservative management. But I will see you on Monday.
Why are you short?
Not in 2000. Now you do. Now, in about 50 large cap, heavily followed stock, you can both sell short for a longer period. I've actually sold short. I sold short in Amazon about 6 years ago for about 18 months. I was able to pay this because it's so liquid, so many shares outside. So, but you're not going to be able to pull that off in an NVIDIA. So some stocks you can buy long-term puts now, which is what they call leaps, to buy long-term. But they're still much, much more difficult to go to have a long position if you think something is overvalued. Or long-term business. At that time, there were no puts at all. There were no long-term. There was really no choice, right? So it was entirely driven by demand and supply for the share. Hi.
Thanks, June. Fixing the cell phones last night. I sent you an email last week because I did a Nintendo valuation. I saw a couple questions that was still a little bit.
Okay.
So when you're